Okay, everyone. I'm glad to see many of you decided to come out today, even though it is September, summer is almost gone, and you've decided to be here with us today. I tried to figure out how to look a little less like an Oompa Loompa, and I have not figured out how to do so. Unfortunately, the lighting is just going to be the way it is. There's the sun is setting and glowing off of a building over on the very close to me, and so I'm just going to look like I'm glowing for the rest of this presentation until the sun stops gleaming off of that building, which is fine. So I do want to introduce a couple people here today. We're going to be talking about development opportunities in British Columbia. Of course, we're having a session today, and oh, there you go, Paul. You've got yourself figured out. We of course need to talk about interest rates too, because it just so happened that today was an announcement from the Bank of Canada, so we do need to talk a little bit about that. That's not going to be the feature of our presentation today. Our feature will be highlighting two different investment opportunities in the real estate development side of things. Dima Itskovich with Maxcellent, who's going to be talking about CHC-Insured Multifamily. We've had a ton of people asking about multifamily, and Dima is actually going to walk through some of the reasons that CHC-Insured is an opportunity, and even walking through a live example, which is really cool. And then James Livingstone and Paul Stefansson, both with Lightwell, are going to be talking about multiplexes in the GVA. I think most of your projects are in Vancouver, but I listed GVA anyways, in case you guys do something just outside of Vancouver. And they'll be going through some of the opportunities with regards to new zoning bylaws and the type of product that they're building. And they have a couple of unique and very cool ways that they're putting together some deals. So we will talk about that very, very soon, but I know many of you want to know, well, first, Kyle, what's going on with the Bank of Canada? Obviously, I need to talk a little bit about this. Bank of Canada did decrease the prime rate, or at least they decreased the overnight lending rate, which is how banks determine the prime rate. That did cut 0.25%. So now the prime rate is at 4.7%. It means that anybody taking a variable rate mortgage will now be seeing that their variable cost and their variable interest will be decreasing by 0.25%. And it is starting to make variable rates a little bit more attractive compared to fixed, and bringing them much closer to about the same interest rate, which is very interesting. Now, in addition to the Bank of Canada cutting, the US Fed also cut. Leading up to today, basically the traders that bet on where the Bank of Canada was going started to creep up to 90+% of a chance of Canada cutting, but had actually priced in about 100% chance of the US Fed cutting as of about a week or a week and a half ago. So the cut in both Canada and the US, especially leading up to this, was expected. And one of the things that's really important to know too is that, yes, the Bank of Canada did cut. That means the variable rate pricing is going down. In the last probably week or two, especially with the weak job report back down south end in Canada, the bond yields, so the 5-year bond yields, have also come down. So if you look at the far right of this graph, you can see that there's a sharp decline in the bond yields, which means that in general, that means that there should be some downward pressure on the fixed rates. Banks have been a little bit hesitant to drop the interest rates, but I'm just starting to get some banks all of a sudden starting to cut just in the last couple of days, and one major bank is cutting as of tomorrow. So we are starting to see a little bit of a shift downwards in fixed rates, which of course is good news. But it's important to know, and I don't have the chart for today specifically, but interestingly, the bond chart today actually showed a little bit of a tick up. And it's very interesting because we're going to potentially see a slight divergence in the medium and long term when it comes to fixed rates and variable rates. I want to show you an interesting chart. And I've been hearing about this quite a bit. And also, I was at a conference yesterday, and an economist also added a little bit of flavor to this to help us understand this better. But what we're seeing is the Bank of Canada still has a couple of cuts to come, expected anyways. People are expecting then, okay, that means the fixed rates should also be coming down, which is not the case, or at least not predicted to be the case, because of inflationary pressures. And one more thing, they're actually predicting the fixed rates will slowly rise over the next couple of years. And one of the primary reasons for this is charts like this. And the problem is that as governments are spending a lot of money, and you can see that the federal government in Canada, the US is even worse, around the world in general, federal governments are increasing spending and increasing deficit levels. What's happening is, in order to raise money to cover these deficits, they're issuing bonds and other similar asset vehicles. And what happens is you have people that sometimes you call them bond vigilantes, but basically large traders that buy bundles of bonds. They're starting to look at the books of these countries. So often you think, a company, but countries get the same treatment, where these bond vigilantes are looking at this and saying, you know what, you need to stop with the deficits, because you're effectively running the country into a position where it keeps borrowing more and more money. Well, that makes the country riskier. And if something is higher risk, then generally it means that in order to invest or own those assets, it should also reflect a higher rate of return. So bond traders are starting to demand and not buying these countries' bonds, and they're demanding a higher rate of return if they want those bonds to be sold to them. So interestingly, even though worldwide economies are starting to show a little bit of weakness in general, Canada and starting a little bit in the US, not a whole lot, but a little bit, you would expect that the bond yields would be decreasing probably a little bit more than what we've seen. But at the same time, we have this other impact, which is an underlying issue, which is that as the deficits increase across the world, but mostly our bond market's going to be a bit more impacted by just Canada and the US in particular. When you see this increase of the debt levels, you also see that bond traders say, well, you know what, I want a higher rate of return, pushes the bond yields up, pushes mortgage fixed rates up. So something that we need to be mindful of. On the flip side, the reason the Bank of Canada is cutting is, of course, unemployment rates are starting to slowly creep up. And so this chart is showing the Canadian unemployment and the US unemployment. And yes, there was a very small tick up in the US unemployment, which is one of the reasons that we saw the bond market start to slide a little bit. And this chart here is showing the job vacancies. So in addition to the unemployment, it's also showing a downward curve in the amount of available jobs if somebody is unable to work. And there's some other charts that I've seen that I wasn't able to pull up that is showing how likely it would be for you to get a new job if you were laid off today, and that the trend is looking a bit concerning, because there's a higher chance of being laid off and a lower chance of getting a new job lined up. So we're starting to see some cracks. As you can see, however, this is not an absolutely dire situation, but we are slowing down. And the problem is that this trend, it's like trying to stop a train. You can't just drop rates a couple times and then boom, the train stops, and all of a sudden the job vacancies relaxes. The unemployment stops to increase. Once things are moving in a direction, kind of like the inflationary issues, it kind of keeps moving. And speaking of inflation, that train is still moving. It has slowed down, which is good. And I think the Bank of Canada, based on their statement today, is feeling a little bit more like, okay, we can kind of manage this, but you probably won't see a ton of major decreases to interest rates, because they still need to be very mindful of the inflationary issues. So what we're seeing and what we're finding is the fixed rates as of very short term, slight decreasing, but really if we start to look at the long term, probably flat to increasing fixed rates. And then as far as the Bank of Canada, of course, they decreased. They're expected to decrease another 0.25% to 0.5% by early 2026. So of course, the question we're getting a lot is, should you be in a variable rate? And that is a very long conversation, not something we're going to tackle today. But a lot of our clients are exploring whether it makes sense to consider breaking their mortgage, because if we are at the low point for fixed rates, and some people are thinking, I don't want to take the risk with the tariffs and inflationary pressure, maybe I want to just lock in for another 5 years. And in some cases, it can make sense to do that. Also, with the cut today, there's the flip side conversation of, maybe I should be in a variable rate, because now all of a sudden the variable rates and the fixed rates are around the same pricing, but with potential cuts to come on the variable side. So hard to make that decision, but if you do want to learn more, then happy to have a chat with you in the future. One of the things I want to talk about today, and the main theme of today, is more about the investment opportunities as it pertains to real estate development in BC. And I think if I take a step back, if you're a real estate investor or interested in investing in real estate, then there's been a lot of changes. I'm going to rifle through this, but there's the BC flipping tax, the federal flipping tax, the capital gains increases. Oh, never mind. No, actually, we're not going to increase capital gains. Thank you, government, for forcing a bunch of people to sell their assets really quickly and all of a sudden decide, oh, never mind, we're going to revert that. Stricter rent controls, enhanced tenant protections, vacant homes and underutilized housing taxes, the short-term rental ban in British Columbia, and a lot of talk about this happening in other areas of the country as well. Elimination of short-term rental tax deductions, and zoning policy requiring affordable housing in some cases. So there's been all of these changes and adjustments that have made it really difficult for investors to find a spot to invest. And frankly, a lot of investors have just decided to pull off. And oh, wait, did I forget? Yes, of course, the tariff situation too. There's so many things that are going on that people are just saying, you know what, maybe I should take a step back and just see what's going to happen and see how this is all going to play out. Now, I think there has been, a number of different buyer profiles. And if you look at what these buyer profiles are looking at, they're all looking at slightly different things. And I find that, this is one of the reasons, and I'll get into this, but there are many different reasons that the market has been slower this year than one would have expected. And obviously the tariffs kind of encompasses all of these. So I'm not going to list tariffs in each category here, but let's position yourself and think about the fact that maybe you're a first-time home buyer. I think a lot of first-time home buyers are waiting for that mystical bottom, which tends to, never come or is very difficult to time. And typically first-time buyers are often condo purchasers. And I think a lot of first-time buyers are also expecting rates to further decrease, which, yes, maybe the Bank of Canada may cut, but I don't know if a significant number of first-time buyers also understand the relationship between fixed rates in the bond market and variable rates in the Bank of Canada, and the fact that they are kind of separate. So a lot of times you see the headlines, oh, Bank of Canada is cutting, oh, rates are going down, I'm going to wait it out. Bank of Canada says they might, or people predict the Bank of Canada might cut some more. I'm going to wait before I get a fixed rate mortgage. And that's not necessarily exactly how this is all going to play out. But I'm noticing in our business and with our brokerages business that many are sitting on the sideline and waiting for the interest rates to decrease, which we're not sure if that's really going to happen unless of course variable rates continue to cut as prescribed. Then you have what I'd call an upgrader. They're more likely to buy when the time is right for them, and they're in many cases trying to reach for detached or at least maybe for a townhouse, something along those lines. And I have found that there have been more upgraders, so more lawyers or other professionals that are thinking, you know what, I'm making good money. I can negotiate on a property now. Now is a good time for me to buy, regardless of what happens in the market. I'm in real estate for a long period of time. I'm going to own this home for 10 years. Maybe now is the right time to buy. And so we have found that there are a decent number of upgraders. So these people haven't necessarily gone away like the first-time home buyers have. And we also have a large segment of the marketplace that I would consider to be downsizers. So downsizers are maybe looking for condos, something with a little less maintenance, but they generally still need a lot of square footage. So anybody that's helping their parents downsize, they have a lot of stuff. And they still want to have their stuff, and they still want to be, living in a spacious home. And one of the things that I find too is that they're often also looking for single floor units. Townhomes in particular are tough because the 3 levels of stairs and having 500 or 400 square feet per floor can be a challenge, especially for more elderly people or people that are looking at downsizing. So this can be a bit of a challenge, but I have seen a decent number of people that are downsizing, and we've helped a lot of people with bridge loans to help that downsizing be easy and effective for them. And then you have the investor market, and right now a lot of them are not keen on condos. In fact, a lot of people that bought presale condos that are closing on them right now are not keen on condos and still have to close on them anyways. But one of the issues is that there's downward pressure on condos, and they still don't cash flow as it stands right now at today's prices. The other issue too with the investors is for a while there, like in 2023, a lot of my investors said, you know what, Kyle, I'm buying GICs. That's what I'm investing in. And so one of the issues now, as interest rates are falling, GICs are starting to pay lower and lower rates of return, getting back to where they were before, where it's not as attractive as an asset class. And of course, are more wary of other real estate developments, in particular because they may have been burned on an investment here or there, and so people are a little bit holding onto the cash a little bit more tight than they used to. And so we're in this weird spot. We have a lot of people kind of waiting around. Millennials in particular, they're all sitting around waiting for house prices to crash before they get into the market. But is that really going to happen? Hard to say. A couple of the things that we're watching and looking out for is the new housing starts. And so when there's lots of new housing starts, we look at, okay, well, what is that trend looking like, and what is that going to do to supply in the future? And this is Canada-wide. You can see that there's a stark decrease in new housing starts. Just starting a couple of months ago, it was starting to increase earlier in the year. But I think as soon as that tariff concern and whatnot started to kind of set in, a lot of these building starts started to decrease. And if I start to look at more specifically in Vancouver, the single family inventory had increased significantly, but we are seeing a bit of a trend here where just in the last couple of months, that slack inventory is starting to decrease. Now, this chart's interesting. Look how far it goes back to 2015. We do have the highest single-family inventory that we've had in 10 years. But the trend is starting to decrease, and it's starting to get closer to 2018 levels roughly, which was one of the last weaker markets that we're in as far as detached were concerned. And so it'd be interesting to see how this continues moving forward. And the primary thing, well, not primary thing, but one of the things I'm looking at and watching here is the single family building permits that are issued, and look at how low this is right now. So I was at a conference yesterday, and at the conference they were actually talking about where they see single family homes in BC, and especially in Greater Vancouver. And with this trend of inventory starting to decrease, I'm noticing this too. We checked, the number of leads that our company has had over the year, and throughout the year, usually we see a bit of a bump up in the spring. This year it was flat from January all the way to June, just flat every single month. We didn't really have that typical spring bump because of the tariff situation. But we did see July, August, and so far in September very busy. And if I look at this chart, you can start to see the inventory starts to decrease somewhere around June, July, and into August. And so I think there is a correlation. I think a lot of people are starting to settle. Interest rates falling is helping a little bit with that. And of course, the new building permits coming down. The economist's prediction was that the detached market will tighten into next year. And so it'll be interesting to see exactly what happens with that. And on the flip side, of course, condos. So new condo sales in Vancouver have fallen quite considerably. And this is where I think a lot of investors are thinking maybe condos can be weaker for a couple of years. So when I look at the market and I look at the challenges that developers have had, one of the challenges has been the inflation and the cost of supplies, labor costs still being high. Some items like steel and wood, potentially could be rising in price. Interest costs. Rates went from low, especially for retail borrowers, went from 1.5 to 2.5 to 4 to 5. And if you were an investor or a developer, land banking, so buying land and then rezoning and getting that all prepped so you can get your building permit. A lot of banks pulled off on that kind of financing, and now those clients are having to go to private lenders. And frankly, most private lenders now have too much land. And in fact, the only asset class for a lot of these private lenders that is underperforming is their land portfolio. That's where most of their foreclosures are. When I say 10% plus interest, I really mean the plus part. A lot of these land lenders are lending out their money at 14, 16% on larger projects. It's very difficult to get land financing at the moment. And this is the big challenge too, pre-sales needed. The more units you have to sell, so if you're selling a condo building, then banks are asking for pre-sales. In general, a target is about 70% of your units to be pre-sold. You go back a couple slides and you see that the new condo sales has fallen off a cliff. It's very hard for developers to get to the point where they can actually sell these units because the pre-sale market is very cold. So there's challenges, and so the investors are thinking, well, where do I invest my money? If I buy a condo, it's not really going to cash flow. GICs aren't really a good opportunity. One of the things I then look at is, well, what are the opportunities in this type of climate? And the two that I like, and this is why I have these two wonderful speakers here today, actually three wonderful speakers today, is to talk about two different things. So the first one will be CHC-Insured Multifamily, and that's basically changing the way investors often operate, which is instead of being, an investor who wholly owns 1 or 2 or 5 units or whatever, instead is changing the mindset to just being a small piece of a much bigger pie. And as far as the reasons to do that, when you're getting into CMHC-insured multifamily, I know, Dima, you're going to go into this in more detail, but high level, lower interest costs. CMHC-insured rates are lower than residential. Longer amortizations, you can get up to 50 years amortizations. A higher loan to value, although it's very difficult, especially in Greater Vancouver, to get up to 95% financing. It is possible. So you can stretch the financing and get even higher financing than you could get even in residential lending. You get economies of scale. So if you're building more units, that's the lower cost per unit. And one of the other reasons, too, is that we had massive immigration in the last couple of years, and most of those immigrants are predominantly renters. And so this fits the CMHC-insured multifamily mold very well. The other opportunity that I've seen, too, is a lot of people are talking about that missing middle. So duplexes, triplexes, fourplexes, townhomes and low rises is kind of that's how they identify it. But really in Vancouver, when we talk about the missing middle, we're really talking more about anywhere from duplexes up to about 6 or 8 plexes. It's kind of the missing middle that people are talking about. Maybe townhomes might get thrown in there as well. And so this is kind of the missing middle idea, and one of the reasons for the changes with zoning bylaws. And one of the cool things with multiplexes in the GBA is it's introducing a new product. And obviously, Paul and Dima is going to go into more detail about the type of opportunities and products. But generally, the keys are they're generally larger than a typical condo, and on one floor. So unlike a townhome where it's larger than a condo, but now it's stretched over 2 or 3 floors, they're larger than condos, but often on one floor. You can also offer varying shapes, sizes compared to condos, and still give people access and shared access to more land. Also, a very interesting thing is that homeowners can become an investor in the limited partnership too, and they'll get into some more details about how that works. And sometimes the homeowner even buys one of the finished units. So we talked about those downsizers. Well, downsizers sometimes think, well, I don't want to sell my home because it's an investment for me. My home is going to make me money. Well, here's a way where the homeowner can be part of the limited partnership, still make money, but then end up buying and being a piece of the end result, 4 or 6 units, etc. Obviously, the new zoning allows these projects to move much quicker, reducing the carrying costs and compressed timelines. The project timelines are much shorter, so that it reduces risk of market changes. There's less accumulation on interest accumulation and then inflation concerns. So with that, I'd like to bring up the first presenter. Oh, here he is. You can see Dima is just getting ready. So I'd like to introduce Dima to come up here. I'll stop sharing my screen now. And Dima, if you'd like to present on CMHC multifamily projects, that would be awesome. Maybe give everybody a quick introduction of yourself too, which I'm sure is in your slides.
Yeah, thank you so much, Kyle. And thanks for everybody that is joining us today. I did manage to get a light bulb above me so that I look a little bit brighter, but yeah, I'm going to talk about multifamily and current market as well as CMHC program. And the idea is that, like Kyle mentioned, you have a situation where you have an opportunity to be in much bigger pond, but relatively small fish in the big scheme of things. Just checking if everybody can see my screen. All right, awesome. Okay, so I called it adventures because it really is an adventure with CMHC. And from a month to month, that adventure could change. The goalpost will change. And so a quick overview. I'll talk about a little bit about myself, introduction. I'll discuss very briefly what, in my opinion, are the go-to investment opportunities and real estate classes to look at today. Then we'll dive into CMHC program, all the important stuff, and look at a case study where those of you who have their calculators ready can pull them out and we can do some number crunching together. All right. So Maxcellent was founded in 2013. And at the time, I was doing consulting for other developers and builders. This is a picture of a project that I got to work on in Victoria. This is now a completed picture I took myself. This was a big master plan community for Boza Development, and it's 370 units, and there were 7 different phases. So I put together, I was working on it about a year before construction started, and I'd go to Victoria every couple of weeks and sit at a coffee shop, and my assistant would line up, 30-minute meetings with different trades, developers, builders, lenders, etc. And so this is how I built the network there, and I met some really cool people over a year of going and visiting pre-construction start, and then I put together the construction team to execute this build. So this is a project in downtown Vancouver. You may be going by it when you go to Waterfront Station. This is a 30-story tower, office tower, AAA office tower, and boy, did they go through some challenges. I mean, when they opened, they were only, I believe, 25-30% occupied. It was right after COVID. And we'll talk about some, future of office as well. But this is 9 levels underground. Again, very, very challenging with the, SkyTrain line that goes to the airport about 15 feet away from our hole. Then this is a project that I work on in North Vancouver for Hollyburn Properties. I have a long-standing relationship with this group, and this was interesting. They did this project, I think, in 2014, and about 130 rental units. And this is a family that has been managing real estate rental for a very, very long time. Now, remember this number. In 2014, you would have 35% equity needed in order to get financing for this project. Okay. So in terms of what asset classes I feel are go-to today, and multifamily rental, it really is almost, I don't want to call it recession-proof, because we're going to see some real challenging times in areas like Vancouver and Toronto, because it's not that we've overbuilt, it's that we've overpriced our product because of the cost of delivery. So all this housing crisis that we're talking about, it's not really, it's an affordability crisis, but it's also a cost of delivery crisis. And so this is a very, stable asset, and it basically a generational wealth builder. The other one that I would recommend in the long run is, and again, what you want to look for projects in multifamily is projects that are completing in like 29 and 2030 and onward. And as Kyle showed, there are very few condo starts, and between 30 to 50% of condos in Vancouver were purchased by investors. And now those investors cannot buy because of the impossible taxes that the government's put. So the projects are not going ahead. So there's going to be a big gap between end of last year, this year, and probably to mid next year, where there's going to be almost nothing starting other than maybe rental. So completion in 29 onwards, I think, will be very strong. And there is a definitely for a AAA office product, like this Boza Waterfront, and also I have a client that had an office building that a 29-story they wanted to build pre-pandemic, and they decided to put it on hold. smart move. But we're now talking about launching the project again, because in 3 to 4 years, I think most of the government employees will be in the office at least 4 days a week, maybe more, and everybody will return because, depending on what your profession is, for most of them, it makes sense to be in the office. What AI will do, I don't know, but it's scary. It is for everybody all around. Now, I call this a bottom feeder kind of approach, where you can go and buy completed condos. Again, this is where you are a big fish here. And there's a lot of realtors out there that do package deals where they go to a developer and say, I'll buy 30 of your completed units at a discount of 15%, 20%, 25%. So developers are selling because they need the cash. They need the cash somewhere else. And if you can figure out if the project has paid for the construction loan, then they have a little bit less pressure to sell at a discount versus a project that hasn't paid off their construction loan, and that project is paying penalty fees, etc. So these guys would want to be more motivated to sell. So this is again another strategy where you can pick up, but I do not recommend projects that are in construction. Those are difficult because you don't know if they're going to finish, and you don't know if when they finish, everybody's going to close on the property. So some risk there. Okay, so let's talk about, why are we in this, situation where we don't have enough rentals, where most of our housing was built before 1990. I mean, this is information for Victoria, but it's very similar in Greater Vancouver as well. And then there were rent controls implemented. And as you can see, I believe it was somewhere in the 70s they were implemented. So there was a decrease and less being built. So the rent controls made it unattractive. And the cost of building increased over the years as well. So this is one reason that CMHC came up with a program in order to incentivize new rental construction. There are many programs that CMHC provides. Really, I will focus on MLI Select, but just so you know, there's another program that's been popular, which is the ACLP, Apartment Construction Loan Program. Why not many utilize it? Because there is a requirement for a big chunk of your units to be affordable, so a minimum of 20%. Now, this program is cool because if you can, I don't know how, but figure out to buy the land for $0 and get a bunch of incentives from the municipality, you maybe can make it pencil with lower rents, but I'm yet to see a project that does. And what happens is that it only makes sense for nonprofits, but you can get 100% financing with ACLP program. Now, 100% financing based on CMHC calculated number, which is not necessarily what a developer would crunch. And in the MLI Select world, there's quite a few flexibilities, and there's been recently changes. So what I'll do right now is go through some details. But if there's one thing that I want you to remember is that there's no such thing as affordable. When people say affordable, they really mean it's subsidized. Because you don't make anything affordable, somebody subsidizes it. It's either the developer subsidizes or the government subsidizes, or maybe both are coming to the table to subsidize it. So the level of subsidy is different on different projects, right? So just very quickly, the CMHC MLI Select program is meant to be for units 5 or larger. And one thing for you to remember is this little thing in green that says non-residential components cannot be above 30% of value in the area. And there's 3 things that they really care about, which is the energy efficiency, the affordability aspect, and the accessibility. And so what you would do is you would pick and choose what makes sense, and then you're trying to get as many points as we can. And the debt coverage ratio for residential is usually 1.1 and you know, a 1.4 for non-residential. So the 1.4 is a bit restrictive, and that is meant to not encourage to use this loan for commercial purposes. And so what every developer is trying to do is they're trying to get to 100 points, which, like Kyle mentioned, can get you up to 95% financing, 50-year amortization. And a big thing here is a limited recourse. So that means that you may be able to guarantee 50% of the loan versus 100% of the loan. And this is, you know, a great benefit when you're doing a number of projects at a time. All right, so a little bit of history. And I say good old days because they were really good old days. You used to be able to get 100 points just for doing an energy efficient building. So you did your step code 3 and you got 100 points, great, move on. And at some point in time, and there's a reason why I bring this project, it's in Langford, they were able to pay for land purchase with the first draw from the lender, right? So you don't actually need a lot of cash up front. You can actually buy the land with money from the loan, right? After rezoning it. So now you can only get 50% for the energy efficiency. So it went to half. It's a big deal. So now you have to do another combination of affordability or accessibility in order to get 100 points. Then in late last year, they came up with revisions. So rental achievement is where they said, you know, they realized that they were funding a lot of projects that were, you know, maybe shaky, maybe they were starting to see a bit of a downturn in the market. And so they said, we will only loan you 75% of the total loan amount, even though you're approved for 95, we'll only loan you 75. And then we will give you the rest 20% once you show us that you're able to meet the rental projections that you projected day one when you applied. And so when the market is increasing, it's easy. When the market's decreasing, it's tough because you may not get the rents that you were forecasting. So the other thing they implemented is a bonding requirement. So a 50% labor materials bond, and it's a big cost. So for you know, I have a developer friend in Victoria that says today he can only do one project at a time because of the cash requirement. Whereas a few years back, or even a year ago, he could do with the same money 3 projects. Yeah, so premium fee increase was in July this year. And so what that meant, let's say for a project that I'm going to do a case study with, it went from 4.6 million premium, which was a 2.8%, to a 4.9% premium. It's almost doubled. It's almost 9 million. So, and again, this is nothing that you can put any revenue against, right? All right, so now down to the case study. So this is a building that I'm in the process of rezoning and entitlement in Saanich. A little bit about it. It's a 300 units rental, 112 unit boutique hotel. We have some live work lofts. The idea for this development is like an arts and entertainment hub, which I believe works really well in Victoria area. We have a lot of amenities, you know, lobby bar cafe, outside plaza, and with food trucks. So it's really cool, unique approach. And now let's get into the numbers. Okay, people with calculators. So just trust me that the rental calculation works out that this is the revenue, and then this is the revenue that you can get from parking. So what we're going to do here is we're going to calculate value, and then we're going to go through calculate the loan amount together. All right. So here what we have, some assumptions: 2% vacancy, 22% expense ratio, which brings us to a net operating income of 7.5 million approximately. And then if you use a cap rate of 4.4, which is what our appraisal says, the value works out to be 270 million for the residential component. You add to that your hotel component. As you can see, hotel only has 112 units, but it hits as 300 units rental for gross revenue. However, the expenses on the hotel side are much more. So with the parking revenue and some ancillary income from various things and upgrades and people that don't show up that are still paying, we're looking at a 80% occupancy. 80% occupancy is very healthy. At 75% occupancy, hotels are profitable. And the bounce back in since the COVID days is amazing, especially in Victoria. Since 2010, Victoria area lost 2,000 hotel rooms. And I know Kyle has a project he's trying to convert to hotel, and which used to be Airbnb. And it went, I believe, from 3,000 listings in Airbnb in Greater Victoria to about 650. So the drop-off is unreal, and it's only starting to filter into higher occupancies and higher rates at the hotels. And the operating expense ratio for hotel is huge. It's like 50%, right? So we take out our 20% vacancy, we take out our operational expenses, we get about a 4 million net operating income annual. And again, we divide it by the 7% to get our value of 58 million. Then we have 5 commercial spaces, a very small commercial component with a triple net lease rate of about $40 and a vacancy of 5%. With triple net lease, I mean, it's a beauty because the tenant pays for pretty much everything. As long as you have a tenant there, you're in good shape. Maintenance is very low. They have to look after it themselves. So that's an additional 4 million. So next thing is we're going to get into the number crunching with CMHC, MLI Select product. So CMHC does a two-step test. First test is related to the debt coverage ratio, and the second one is related to your cost of the project. And so they use the lower of the two. What you're seeing on your screen right now is a loan utilizing the DSCR calculation. So ceiling rate is a rate that is presumed to be used during your takeout. So you finish your build, and then it's time to you stabilize the building. It's time for you to pay off your construction loan and the other term loan. And so, for example, in today's world, what this number will be, just so you get a bit of awareness, is I think CMB today is about 3% for a 5-year bond, and for a 10-year, it's maybe 3.45, something like that. So typically, the rate that we would get is about maybe 0.4 above the CMB. So if we're looking at 3, so it'd be about 3.4, 3.5%. So the reason that we're carrying 4.25, it's because we are finishing this project in 2029. It's a 3-year build with construction start next summer. So we're expecting the interest rates to move up slightly. Again, with a beautiful 50-year amortization, we do our debt coverage ratio calculations, and then we get to these numbers of NOI, which pays for a mortgage amount using the DSCR, summarized for all these three, of about $203 million. Now, the whole cost of this build is about, I believe it was 204, 205. So if you look at this method, then you're almost getting 100% of the loan that you need. However, on the cost side, of course, you'll only get up to 95. So I'll move to that one right now. So again, a division into hotel, rental, and commercial. And some of and here, as you can see, this is the fee, 8.8 million. So that's the change that happened, and it went up by 4.2 million just from July till today. So then when you calculate, they'll only lend you up to 75% loan to value on your commercial product. And the residential, they can loan up to 95% if you qualify. So when we look at this altogether, here we can get about 75 175 or 176 million in loan based on cost. And then you add your CMHC premium fees on top, which works out to 183 million. So this is the loan amount that we can get, 183 million. Okay, let's look at the profitability and some metrics on this project. So here we have, if we are to sell this project after stabilization, then we're looking at a value when you add up rental, hotel, and commercial of 235 million. And some of the metrics that developers use, with our cost here of 204, we get a 31 million profit. 15% return on cost is very healthy. In today's world, we have developers moving ahead on projects where they have between 8 and 10% profit on cost, which again is very risky because costs can go up and you might be stuck. The IRR is another a time-weighted return that is often calculated and used in determining projects and comparing one to another. So we're looking at about a 25%. Again, that's very healthy. And then we're looking at a capital stack of how this loan gets built up, where you can see here 20,700,000 is the equity requirement, which works out to be about 10%. I don't know if I lost anybody, but there'll be an opportunity later for you guys to ask questions. So about 90% loan to cost. All right. Here's the trick though. When we rezone this project, we gain about $7 million in land lift. And that counts towards the equity. All right. So those of you have calculators on you. What does 13.7 million divided by 183.7 million? Maybe you want to throw it in the chat. Okay, my calculator says it's about 7%. So what that means is that our real cash requirement will be about 7% of the total cost, or we are getting 93% loan to cost, which is amazing. And this is why these projects make sense. This is why this program has been a winner. And this is why people are saying that Vancouver's overbuilt with rentals, because we're going to a lot of projects, rental projects are finishing, in 25 and in 26. So there'll be quite a bit of supply. All right, so very quickly, more about this project. So it's located in Saanich next to Tillicum Center. It's about a 7-8 minute drive to downtown Victoria, 15-minute drive to Langford, 25-minute drive to the ferries, 20-minute drive to the international airport. Very close, and there's again a mall, walking distance, save on foods, etc. Why I like Victoria specifically, it's because today the unemployment rate in Victoria is 5.1 versus 7.1 in Canada. So, and what makes it is one big reason is the NDP government. So there's about 35,000 workers that are provincial government employees, and half of them live in Victoria. Then you have your colleges like UVic, you have the hospitals, and the tech sector is actually really booming because there's there's the lifestyle, and then there's very fast internet, and so it really works. And the tourism industry is really exploded since COVID. And now I am going to invite you to October 1st. I'm having a quick continuation on this project where we'll dive a little bit deeper. So if your cell phone, you can scan this QR code. And if you're interested, we could have a more in-depth discussion about this. And now I'll just open it to questions. And if there's any questions you guys have, you want to throw it in the chat, then I'm happy to answer. I'll maybe wait a couple minutes, and and then we'll keep going.
Cool. I also just put up a poll, so if anybody wants to get more information, feel free to say yes or no in the poll, and then that way Maxcellent knows who to reach out to and give you guys some more information. So we'll let people fill out that poll, and then if there's any questions, we can fill those in. And then, of course, we'll have a Q&A at the very end too, if anybody can't think of any questions at the moment. Thanks for that, Dima. Appreciate it.
Thank you so much.
Yeah, cool. So far, oh, here we go. Q&A. Okay, so there's a question here. So Ron wants to know, what is the minimum investment amount in the project and other similar projects?
All right. So right now it's open to sophisticated investors, or why does it escape my mind?
Accredited investors?
Accredited investors. Yes, thank you. I should know this. Accredited investors. So our minimum is 150,000 investment, and but we are looking at potentially teaming up with the Addy platform, which is you know, you can invest as little as $100-$500 and also participate in this project.
Cool. Thanks, Dima. Okay, awesome. Well, I'll finish up and end the poll now, and then Dima will be around at the end if anybody has any questions. Awesome, thank you. All right, next up, is it James? Are you next up, or is it Paul?
I'm next. I'll provide an introduction to Lightwell, and then Paul will deal with the meat from an investment perspective.
Sounds good. I think it's up, but you would just want to start the presentation because it's
the toolbars in front of it can't connect on it.
Oh,
there we go. We got it.
There you go. Perfect. Yep, you're good.
So yeah, my name is James Livingstone. A little bit about me. I was a chartered accountant and CPA for a long time. So I was a partner downtown at a firm called Woolridge Mann. It's now called Baker Tilly. And it was a great experience. I learned a lot about businesses, but really what I was trying to solve for back then is how do you how do you take a 10 million revenue business and get to 100 million revenue? And so I started in audit and tax, and I switched over to corporate finance. So that's where I would help my clients buy businesses and sell them and finance. It was quite interesting. But eventually I left public practice to buy companies. So I ended up buying 24 businesses across Canada, US, and in England. So learned a lot, but lots of travel. And with the pandemic, I reevaluated my life and said, well, there's got to be a problem I can solve here in my backyard. And I attended a multifamily conference, and it was pretty obvious. People were talking about affordable housing. I agree with Dima. I mean, it's really only affordable housing is government subsidized, but ultimately, we can build. I was looking to build housing that was less expensive in the right neighborhoods, and so I decided to instead of focusing on towers, and Dima's really experienced. I don't have that experience. But I've got a lot of experience in manufacturing. I've owned a lot of manufacturing companies. And about the time that I was looking at getting into this, the city of Vancouver brought through the multiplex bylaw. It was perfect, because the scary thing about development for me, because I didn't have a lot of experience in development, was zoning. And with the multiplex bylaw in Vancouver, and then later, almost the same time, the provincial government came out with Bill 44, which is the Small Scale Multi-Unit Housing Act, and we call that SMU, and that's what applies everywhere else. So we're active now, and on the west side of Vancouver, a little pocket by Fraser Village on the east side, and we're in Port Moody and Coquitlam as well. In the suburbs, it's interesting, Kyle, you're showing the number of detached homes on the decline. But what we're building in the suburbs are detached homes. It's just we're building 4 on one property. And so the pricing is more attainable. So a brand new house in Port Moody would be around $3 million. We can build a detached home with a garage for say 1.5 to 1.7. So it's really that missing middle. So when we're out looking in different jurisdictions, it's really we're trying to solve the problem, which is how do we create lower cost housing? Obviously, you're not going to get a 4,000 square foot house, but you get a nice house. I can't do this alone. So we have Paul. He'll introduce himself in a little bit. But ultimately, I knew enough about construction. I've owned industrial construction companies. It's really relationship driven. So for me to just try to do this by myself, it'd be really hard. So with Randy, 19 years construction, has been building duplex and single family homes up to when I met him. And he's been fantastic, very organized, keeps costs down. We're a low cost producer, but we're building beautiful homes at a custom standard. Jonathan, he focuses on the land acquisition. We have 18 developments on the go, 2 in Port Moody, 16 in Vancouver. So he's the person that goes and negotiates and finds the opportunity. Me, I'm focused. I have a lot of experience scaling businesses, market analysis, obviously the finance side as well. So equity and debt, and just understanding, risk management. Eric's really interesting. Eric has a tech background, built up a cybersecurity business, sold it, started a family, and he was investing in a lot of townhomes. And at the beginning, he did well, but the last few years, townhome investment's been really hard on the west side. So most of the projects that he invested in have been losing. The equity investors have lost money, and it's because with townhomes, you're having to build a concrete underground garage. And you're rewarded with 1.2 FSR. With the multiplex bylaw, we're at 1 FSR. We can build slab on grade. So another reason why I like multiplex. What drew me though to multiplex, and Paul will get into all the details, is just short duration. I was investing in companies. I'd buy a manufacturing business. It would take 5 or 6 years to build up earnings or longer, and then you're hit with all the macro cyclicality we're seeing. Like, look how tough it is for business owners. They're dealing with tariffs now, but starting with the pandemic, huge changes there, and then high interest rates, supply chain changes, pretty stressful. So I wanted something that was shorter, and that's where with multiplex, our investors are invested for less than 2 years. This is an example of what we like to buy. This is on West 17th. This is in Lightwell 3. Not a lot of value in the home. This is a 6,300 square foot lot. So this will be demoed in a couple of months, and we'll build 5 homes here. And this is Cambie Village. Cambie Village is in terms of popularity, number 2 behind Kitsilano. Laurel Street. This is in Oak Ridge. We're building 6 homes here. Kyle was talking about the missing middle. And for me, I think about the middle between duplex and townhome, because we're not competing with rental buildings or detached homes. And ultimately, when I was looking at duplex, there was a few problems with it. Here's people on the west side are paying up to $1,800 a foot. Probably average is $1,550 a foot, and this is your 3rd floor. So it's really a walk-in attic. So the duplex zoning is 0.7 FSR, meaning if someone had a 4,000 square foot lot, they could build 70% floor to space ratio, so 2,800 square feet. They're given, the rule is if you keep the ceiling height below, I think 7.4 feet, you can do this. So it's really not useful for adults. So in my opinion, homeowners aren't getting good value with half duplex. And these are expensive, 2.4 million to 3.2 million. Townhomes, there's some really nice townhome projects, but they'll be more expensive. This is a typical townhome. They're 10 to 17 feet wide, quite narrow. With the bylaw, we have less, we can't have 1.2 FSR, we're at 1 in Vancouver. And so ours are about 20 to 30 feet wide. So we're much wider, very livable. Here's just example of some of our projects. This is Willow on West 57th between Oak and Canby. This is an example of a stacked townhome. Kyle pointed out how versatile it is. You can build over a dozen different formats. It's quite interesting. So with this is the one level home, and we target downsizers for that. Think of people in their 60s, 70s, 80s. Knees hurt, the hip, back. So to go up and downstairs, yeah, Paul, I think has the back issue. But there's nothing out there other than condos, and many downsizers are going from a big house. They don't want to go in a condo, but there's no product. So we have a number of developments now where it's exclusively one level. We stack them. So the second level on top has their own elevator. So we're putting more and more elevators in. When you think of Vancouver, who has all the money in Canada? It's people over 60. It's not Gen Z. On top, we've stacked two-level homes. Those are big. Those are 1,800 square feet. That's more aimed at the families. We use interior designers, so everything's beautiful. This is an interesting development on Ground 34th, Shaughnessy. Shaughnessy has a lot of big lots, expensive lots, so there's virtually no duplex there. I found one duplex that's for sale, and they're over $3 million. Ours will sell for between 1.9 and 2.2, so much more reasonable. And these are big. These are front back duplexes. The old half duplex zoning, they can go up to 35 feet. We're almost 38 feet, plus we get the full 1 FSR. In the back, we have two-level homes. So this is a good example of the two main formats we're using. And a lot of what we do is 6 homes like this, where you have 2 duplexes, and they're, I'd say premium size. And then in the back, we're constrained. We're only allowed 2 levels in the back. But the nice thing, these are 1,470 square feet. So each floor plate is about 735 square feet. So they're quite roomy floor plates. This is another example. This is Solon, just launching this shortly. And this is, again, big duplexes with the carriage homes in the back. This is on East 23rd. This is under construction, a modern Tudor look. So we can apply different aesthetic, to the exteriors between modern, contemporary, Tudor character, like the craftsman. And another example, this is West 33rd. But they're nice, they're spacious. So it's adding something that both half duplexes and townhomes don't have. Because really the compromise before has been livability in exchange for parking. In the case of this bylaw, the parking's in the back. So one spot usually, per home. Here's an example of a floor plan. I hope everyone can see it. This is the entry down here. So you come through, cabinets are on the right-hand side. So you're not coming in right into a kitchen or living room. You have time to put your shoes and coats away. The kitchen itself is 22 feet wide. The kitchen island is 9 feet by 4 feet. So these are all house size. Dining, living room. This is 9-foot ceilings here. And the bedrooms you can have king-size beds in them, 10-foot ceilings, walk-in closet. So for a couple, it's really ideal. So we're getting a lot of compliments on this. On families, it's really 2 types of families I view. It's families with children, and that's really, they're interested either in lifestyle, so it would be Kitsilano, Canby Village, Maine, Fraser Village, or the school districts. So Lord Byng on 16th, people are moving to Dunbar, Mackenzie Heights, West Point Grey for the school. Oak Ridge has the top, Jameson is the top publicly ranked elementary school in the city. So lots of demand for the Oak Ridge area as well. In this case, we're showing 2 levels, but we'll build 2 or 3 levels. So what we'll do now is switch over to Paul. Paul's going to get into what we do and all the numbers.
Okay, just give me 1 sec here. Okay, I'd like to kick off by asking you guys kind of an odd question. How many of you can remember when you were 25 years old? It was 1997 when I was 25 years old. And what I'd like you to think about, what were your dreams and aspirations when you were 25 years old? You know, for me, I wanted to get married. I wanted to have 2.5 children, 1.5 dogs. But most importantly, I wanted to own a home. And the reason I've gotten into real estate with James is because I think this generation has essentially given up on home ownership. And why is that? It's because we've really failed this generation. We've really failed our children. I think it's, largely due to NIMBYism, where, 80% of most cities are single family homes. Regulation, has slowed construction. I've been waiting 18 months to build a garage because of a tree, and taxes on condos are something like 30 to 40%. And that's why I was very happy. While I don't always agree with the NDP, I was very happy to see the city and NDP bringing in multiplex, because it solves a small part of the problem and really, I think, helps us, fix this problem for the next generation. So who am I? I always like to say I was born in Winnipeg. I chose Singapore. I spent 23 years in Singapore, and they have quite a few innovative ways to build in Singapore. And then I chose, of course, the best city to live in, Vancouver. Any guess, or best city in Canada, which is, of course, Vancouver. That's why we moved back here. 2 children, one through IVF and one through adoption. Professionally, I was an actuary, so a lot of numbers like James, equity analyst, CEO, and MD at a big bank in Singapore, UBS. And then finally, I've joined Lightwell. And now, one thing that's been consistent is I've always been interested in real estate: Canada, Malaysia, Sri Lanka, and Singapore. So real estate is really something that's already been through. You know what multiplex is? You're essentially taking one home down here, you can see on the right, a home built in 1913, and replacing it with 6 homes that you see on the left. Now, of course, we have to let you know that this is not investment advice. I came from a big company, so we're always careful of this stuff. But really, the question I think that I like to ask myself is, how big an opportunity is this going to be? And if we walk through the numbers, there's about 44,000 homes in Vancouver. If 10% convert to multiplex, you get about 4,475 multiplex sites. If on average you put 4 houses there, we're going to have almost 18,000 new homes. With an average price of 1.5 million, that's 26 billion in new homes. At a 15% profit, this is a $4 billion profit. Now, I'm always a bit skeptical when something seems to be too good to be true. So I had a few questions that I had to answer before I got interested in this. And as I mentioned, the biggest problem I have with all real estate in Canada is permits. It's not like Singapore where things happen fast. Permits, have held me up from building a garage and a laneway for 18 months. So I couldn't possibly understand how you could build 6 houses. Now, the good news, I think, is the multiplex regulation helps you cut through a lot of the permitting, but still you need to get a development permit to lay out the site. You go through 3 rounds of checking, a building permit for each building, and then go through 3 rounds of checking again. The trick that James and Jonathan figured out with multiplex was, when they buy a house, they try to get a 12-month closing date. You can start your permits on as soon as you put that 5% down, which doesn't, diminish the returns because you've only put 5% down. How many permits do you think it takes to get a multiplex going? Well, the answer is 12. There is 6 building permits, 2 sewer and water permits, a development permit, a street use permit. So lots and lots of things. And so for a developer to make money, you have to have a very efficient permitting project management system. And that's one of the critical things that Lightwell does do. The other challenge when you pencil multiplex, a lot of people, my realtor told me multiplex doesn't make any sense because you can only build it $500 a foot. You can't possibly build a home for 1.5 million when you put the land cost in there. So how's this going to work? When I met with Randy, James's partner, he showed me on 950 West 57th how he's building at $280 a foot. And what that allows you to do is build those $1.5 to $2 million houses. If you look here, what you see is the average selling price in Vancouver West of houses. They're all above 3 million. This product just doesn't exist. So that's very important. But again, for a good developer, you really have to have very good cost management. James has touched on the people that are going to buy it. These are great places for families and giving people back the dream of home ownership. And also for older people like me, you can stay in a nice neighborhood and stay on one level. So what is multiplex? If you go into the details, you can see again my point, 80% of Vancouver now, the single family homes allows multiplex. And you need a lot of things for multiplex. You got to have R1-1 regulations, laneway, 33 feet at least frontage, 3,300 foot coverage for the site, no floodplains. So where I'm in Southlands, I couldn't do that. And we think the best places are essentially from University to Oak and between Fraser and Maine, and 50 square feet of frontage and 6,000 square feet of land. So how many homes can you build on an example of this house here, 3357 West 26? Well, it's got 59 feet of frontage, 7,600 square feet of area. So you can build anywhere from 4 to 6 if you're going to rent it. Now, this house is very old. It's from 1913, so it has no value. So that's a critical thing when you're looking at multiplex. You can build the whole lot. So you get to build a full 7,684 square feet. But there's a density bonus, and when you calculate that in this area, it's another 322,000. So the city does need money to connect sewage and all sorts of stuff. But if you're going to build the whole lot, it does get a little bit expensive. The next thing you got to do is figure out how you're going to put these units onto a site. And this is where you really get some magic. Randy and James spent a tremendous amount of time on this. And it's how you fit the units in there, because you can only cover half the site. If you go over 4 units, you've got to put in something called a pad-mounted transformer, which is another $160K and takes up space. You got to fit parking. You got to get trees in there. Going forward, you're going to have to put in a detention tank for rainwater. So it gets very complex when you're starting to figure out exactly how to put that on the land. The ideal multiplex, ironically, is this house. Doesn't look like much, but it's absolutely perfect. It's between UBC and Oak. It's got over 50 square feet of frontage, 6,000 square feet. It's flat. But the most important thing about this particular area, there's no competition. There's no apartment blocks. There's no nothing. So it should be much easier to sell this because of that. And that's where we get into the numbers. And this is kind of where I got really excited about investing in multiplex because of these numbers. And so land starts at about $500 a foot, but recently, James has found land that's considerably less than that in very good areas. So that's another opportunity. Land costs are down a bit now. Hard costs at $300, critical. Soft costs at $310 gives you $1,150. You sell it for about $1,400, you almost have $300 of profit. Now, one of the things that's critical for this is making sure you stay on time and also you stay on budget. And that's why we use a bit of software called Buildertrend to try to do that. Buildertrend also allows us to really manage the costs. And I found this very interesting. Those of you not in development, 88% of the cost, not surprisingly, is the land, it's the trades, but interest is $1 million. So interest and time becomes critical. And finally, city fees and permits plus tax is another $1 million. That's 88% of the project. Now, when you look at the return drivers, and again, it's why we, put a 12-month closing. As soon as we start building, we start pre-selling, and that's why we have a presentation center, because that allows us to get you in and out in 2 years. In any investment, the faster you get in and out, the better. Almost every real estate deal I've been in has been 5 to 10 years. So long times. 2 years is much more manageable, and you have a little bit better predicting the future. Obviously, costs are important, but the good news here is the land price is going down. It may be offset by the selling price. Finally, this is really the thing that excited me. This is about $4 million in equity, 3.9 equity to do this. 75% also, is in another $12 million in debt. The profit, if all the numbers work out, this is a pro forma profit, so this is a potential target profit, is $2.9 million. For a limited partner investor like myself, that would turn out to a 53% return, or depending how long it takes, 34% per year, because we're thinking we're going to get it done in less than 2 years. So this is really what got me excited. So, 6 houses go in here. That adds a tremendous amount of value, right? That gives you your 50% return, and you get done in 2 years. This is the very exciting part about multiplex. It's even better now. What I'm showing you here is, Canadian real estate prices since 1970. In 76, when I was that 25-year-old, real estate just got killed because interest rates went up to about 15%. Sometimes I think my brother's first mortgage was 20%, but notice it came back. In the 1990s, we had a commercial real estate crisis and a recession, but again, it came back. During the great financial crisis, again, went down, came back. We had a big run up during COVID, and then in COVID, inflation has taken it off about 20%. Nobody knows where the bottom, as Kyle says, but it certainly looks like it's a good opportunity to get in right now because, land and multiplex is on sale. Now, I'd like to close with a quick story. I've been a shareholder in Berkshire Hathaway since 1999, and you can see me and Warren there. The good news is I think I've lost a little bit of weight there, so I'm a little bit thinner now. So, that's good news. But Warren says to be a successful investor, all you have to do is do two things. You don't have to have high IQ. You don't have inside information. You just got to have a framework for making decisions, and then you can't let your emotions corrode that framework. So I built a framework that I call the PIE framework or the PI framework through a bad experience that I had. In Singapore, I had a very good friend, Andy, who I really respected. He was great at real estate. He made a ton of money in real estate. We had started a university in Singapore and Ho Chi Minh in Vietnam. And he was a great businessman, sales guy, fun guy, great guy to golf with. Really liked him. And it was 2009. I was working for a bank and things were terrible. Many people had lost 30 to 50% of their money. I would go into meetings and, clients would be crying because they had lost so much money. And my stomach would almost twist because I felt responsible because it was the bank's advice and my advice that had gotten them there. Luckily, most of them had stayed in there. It turned out fine. Other ones were just screaming at me. Some were suing. And it was a terrible time, crying, screaming, suing. And my friend Andy calls me and says, I want to buy a $40 million building, which seemed like a tremendous amount of money to me. But he knew that this was a good time to buy in a crisis. The Chinese have this expression, Wei Ji, the crisis is danger plus opportunity. And so we raised the money and we did very well with that one. We got into it. It was about 80% empty. I think I saw a rat the first time I was in there. We fixed it up, strata titled it. The casinos came in and we literally had a buying frenzy. We 5x'd on that one. So buying during a crisis is a great time. Unfortunately, Andy got a little greedy and started cheating his partners. And we ended up suing each other to the Supreme Court, and it went into receivership and so on. Ironically, didn't lose any money. Everything worked out fine, but it helped me develop my framework, which is property, integrity, and experience. So property means you really got to look and understand the local property. So very important, location, location, location. That's the easy part. But you've got to make sure your partner has got good integrity. Buffett always says, when you're looking for people, you want three things. You want intelligence, you want energy, and also you want honesty. And if you get the first two and you miss the last one, you got a huge problem. And that's what I had. So integrity is important. What are the incentives? Are they fair? What are the splits? 50-50, 70-30. What are the fees? So integrity is really important. Then experience, have people actually done, this kind of building and so on before. So I think if you follow this framework, I think it can really help you, make better decisions when you invest in real estate. And to close, I'll just close with one of the most important things I do before I make a big investment. I always ask my wife this important question. If I didn't have any money, would you still love me? And my wife is very wise, and she thought about this for a long time, and she said, I'd still love you, but I really miss you. And so it's really important when you're investing that you really look at the risk. James always calls himself a risk manager. And so what are the big risks here, right? Well, you don't get your permits. I think there's a bit of a solution there with the 12-month closing. You don't build on time. Well, Randy's got, 18 years of experience, and he's shown that he can build at this level through very aggressive project management. The real big risk is what are you going to sell it for? So that's where I'd end. I think it's important you have some, good framework, and don't let the emotions scare you out of the investment, because making no decision is also making a decision. And as Buffett says, cash is a terrible long-term investment. Back to you, Kyle.
Awesome. Thanks a lot. I'll launch another poll here. So if anybody would like to get more information from Lightwell, feel free to say to click yes there, and then we'll know who would like to get some more information from Lightwell. And yes, perfect. You've got your QR code as well. There's an event on September 29th at 6 p.m. At your education center, which is great. So awesome. What I'd like to do now is just open up for some questions. So Dima, if you're, yep, there you go. If anybody has any questions, happy to answer questions for any of us. And then once we've wrapped up and there's no more questions, then we'll let all of you go. And don't forget that there are the two events. Dima's got one on October 1st at 7 p.m. and then this one on September 29th at 6 p.m. for anybody that would like to learn more. Sometimes it takes a minute. Sometimes people are shy. Surprised there aren't more questions. Everybody's good? No questions? Nothing? Going once? Going twice? Okay, awesome. Well, if anybody does have any questions, we'll send over some more information just to everybody so that if you do want to learn more, you know how to find everybody, where to find James, Paul, and Dima. Thanks for coming out to the event. I was excited to talk about real estate investing opportunities in British Columbia specifically again, and it's been a while since I've really had much excitement about investing in development. It's had its tough times in the last couple of years, and I think these are the two unique ways that I think that investors and developers can make money and profit in the development side of things. I think there's other developments that are more concerning at this point in time, and these two seem to be the bright lights amongst all of the darkness. Which kind of reminds me that I am currently in the darkness amongst a bright light right now, because otherwise I was too dark. And it was kind of funny, the cleaners came and turned on the lights, and then I was dark again. And anyways, I tried to stop fiddling with the lighting, and I just decided that it's not gonna be perfect. Anyways, thanks so much for coming, everyone. I'll wrap this all up now. I'm glad to see a number of you coming out. Look forward to seeing you guys on the next webinar. We'll be launching and letting you know when that one's coming up. And don't forget about the events September 29th and on October 1st. Thanks, everyone. Oh, I do have a question for Q&A. Oh, there is a question here. So minimum investment for Lightwell.
250,000 normally.
Yeah, cool. And also, I know you didn't get into this, but well, I guess you kind of touched on it, but homeowners can roll their property into this, and they can be part of the limited partnership too, right? So, yeah,
absolutely. Co-investment, yeah.
Yeah, cool. Okay, awesome. All right, thanks everyone. We'll wrap up.
Thank you.
Have a good night. Thanks.
Bye.
Yeah, bye.